Hey everyone, welcome to a brand new episode of In the Money with Amber Kanwar. This is, if you can believe it, our 27th episode, and we can now boast our episodes have been viewed nearly 200,000 times. I want to thank all of you for joining me on this journey. And just in a short period of time, we went from a raging bull market to on the verge of a bear market. The tone of our guests have changed, and we want you to be in the know, in the money, dare I say. So wherever you're listening, please smash that subscribe button. If you're listening to us on Spotify or Apple or even on YouTube, it goes further than you'll ever know. We appreciate it. This episode was super interesting. We've got James Davolos on the show, and he's saying something that a growing percent of the investing population is starting to say. We are in the middle of a regime shift for markets. We're not going back to the Mag 7 or tech leadership. He fundamentally believes that you need to own real world assets, whether it's gold, whether it's infrastructure. And you know what? He puts up the numbers. His fund has been some of the best performing funds in the last couple of years in the US. And he does that with the help of a bunch of Canadian stocks as well. He's also got a bunch of inflation-linked stocks that he thinks can outperform if inflation is going to continue to rear its ugly head. So this episode is chock full of investment ideas. Let's get into it. The information provided in this podcast is for informational purposes only and does not constitute financial, investment, or professional advice. The views expressed by the host and guests are their own and do not necessarily reflect the opinions of any organization or company. The host and the guests may maintain positions in any securities discussed on the podcast. Always consult a qualified financial advisor or professional before making any investment decisions. This episode is sponsored by BMO Investor Line. All right, In the Money listeners, you're constantly analyzing charts, spotting trends, and making calculated moves. That's where BMO Investor Line comes in. Take your trading strategy to the next level with their advanced platform. This is packed with real-time data, options analysis tools, and commission-free ETF trading. Plus, open a new BMO Investor Line account and you can earn up to $3,500 cash back. Learn more at bmo.com/advanced trading. James Davolos of Horizon Kinetics, thanks so much for joining us.
Thanks for having me. Really exciting times to speak.
Oh my gosh, there's really no shortage of things to talk about right now in the markets. But before we do that, maybe it's worth just spending a beat on what your bent is, because it's super relevant to the time that we find ourselves in. But just take us 30,000 feet. What's your general approach to the markets?
We have always been dedicated value investors. And I think that a lot of value investors will go back to the Warren Buffett, Charlie Munger playbook of saying that macro is nothing more than weather forecasting. So all I do is look at my companies and value them. And believe me, I would love nothing more than to spend my day analyzing businesses and ignoring the vicissitudes of global trade and inflation and interest rates and tariffs. But the reality is that you cannot ignore these things in today's day and age. And so about 7, 8 years ago, we started to get frustrated by what we thought were inefficient, increasingly inefficient markets. And the two most readily identifiable culprits that, in our opinion, were A, artificially low interest rates, particularly in the United States, but it was a phenomenon worldwide that was creating distortions in risk asset markets, which was then exacerbated by the second variable, which was the growing and now dominant form of investing, which is passive. So we formulated a thesis that at some point, this combination of low rates, incredibly high fiscal spending was going to break out into a new regime of higher price levels, i.e. inflation. And we can be very thoughtful in how we define inflation later on, but we're of the mindset that we are exiting an artificial period of incredibly low rates, stable, if not low inflation, which facilitated what might prove to be the best decades ever for capital asset pricing. And that's not to say that there's going to be a crisis or a disaster ahead. It's just that things were pretty much as good as they could possibly be for the past 10, 15, 20 years, and things are changing today, namely a normalization of price levels and interest rates.
So that feels super relevant to the time that we're in right now. But I want to cut to even just a couple of months ago. How hard was it to hold on to the conviction? Because we're coming off of a tremendous bull run for equities, 2 years in a row of huge gains for the S&P 500, even in the face of rising interest rates, even in the face of, inflation not really getting back down to target. And even the biggest bears out there were scratching their head to figure out, what are we getting wrong? Why is the bull market so relentless? How did you hold on to conviction during that period?
I'm very fortunate in that I work for a closely held asset management firm where the founders who worked together for now close to 40 years own the firm, and they invest their capital over $1 billion collectively alongside our clients. And they take a 3, 5, 7, 10 year outlook. And so we're not judged based on calendar year returns. But we've also been very fortunate in that, in spite of not owning any of the Mag 7 and AI hype geist that has been driving the markets, we've not only kept pace, but we've actually outperformed. And so, even though maybe kind of some of the top down and the narrative and client conversations have not been the easiest, those two variables have actually made it a lot easier than you might imagine for a traditional value oriented firm in the face of the markets over the past 48 months or so.
I'll underline that, and I'll go one step further. We talked to a lot of people who are maybe cautious, but they underperform the markets. In 21 and 22, you had one of the best funds around, as rated by the Wall Street Journal, and one of your flagship ETF products, the inflation linked Horizon Kinetic ETF, ticker INFL, is up around 20% over the past year. It's trounced the S&P 500 over that time. So that's worth putting out there in the context of, you say we are in some sort of regime shift, and obviously you're positioned the portfolio for that regime shift. You're not the first guest, though, that has talked about this being a tide turning moment, getting off of maybe AI and tech stocks, and pivoting towards something else. So talk to me about what's underlining that regime shift. What are, the 4 or 5 things you see happening in the macro picture that's different from what we've enjoyed over the last decade?
Great question. And so I think let's unpack why we've had such an incredible environment for capital markets over the past, let's just generalize and say 20 years. And obviously, it has not been without some bumps in the road. We had the financial crisis, we had the pandemic, we've had some smaller issues along the way. But broadly, going back about 25 years, you had the beginning of globalization, or really the beginning of, I'd say, the modern acceleration of globalization. And so, what did that do? That imported inexpensive goods and labor from from the east into the west. So right off the bat, you have disinflationary forces that are flowing directly into the pockets of Western consumers vis-a-vis corporate profits and then low cost goods to individual households. So right there, that is setting a stage for something that is not necessarily repeatable, if not reversing today. The other large variable that was shifting around this time was that's kind of when the internet really hit critical mass and became a business application as opposed to simply a you know AOL chat function thing for consumers. That resulted in abnormally high productivity from 1999 through probably about 2000, through the global financial crisis. So that productivity was also a large boon towards the economic growth. Meanwhile, we also had mobilization of resources worldwide, whether it's Central American non ferrous metals, It's hydrocarbons in the form of US shale. It's former Soviet states that are mobilizing different types of fertilizers and grains. So, anyway, you had this really almost perfect storm of variables that could promote economic growth without that dreaded inflationary breakout, which allowed the Fed to be very accommodative. So obviously that culminated in the global financial crisis, which then is how we ended up in that zero rate era. But again, what the overbuilding largely around the BRICS growth, Brazil, Russia, India, China, the build out of that growth leading up to the global financial crisis more or less took an entire decade to work through those backlogs. So now let's look at where we are today. Instead of having globalization where we're importing disinflation from Eastern markets in the form mostly of goods, but also labor and different types of services, now you're seeing nationalism and you're seeing East competing with West for those same goods, for those same services. Clearly, there's some nuance there, but you can see that with tariffs today. You've also seen a very high depletion rate of the highest quality and lowest cost reserves, whether it be the top tier shale wells in the Permian Basin in the US, or the lowest cost, longest reserve life offshore wells. Copper right now, you're seeing incredibly low grades with new builds to the extent that there even are new builds. Um, and then you're also seeing kind of this tailing off of productivity. So, what all this leads to is that you're going back into a more normalized environment where there's going to be price push, meaning inflation, which is going to prevent interest rates from going back to zero. I would argue below 2% even. And so now, instead of this era of what was essentially free capital just flowing into risk assets, now there's going to be a scarcity around assets, a scarcity around profit margins, and a reorientation of capital markets. And just to quickly put a period on that sentence, think about what that era really benefited from, and then look at where all of the zeitgeist has been. So clearly, the tech trade, and to their credit, a lot of the enterprise growth has really materialized in a lot of cash flow. AI is yet to prove itself out, but private equity, what's better than having low rates, pro-cyclical growth where you could get credit for basically free and lever up your beta? Well, now they can't exit any of their investments. Also, profit margin expansion. So if you look at the forward earnings estimates for the S&P 500, you're baking in something like 16% operating margins versus a pre-global financial crisis trend that was around 10, 11%. So clearly there's been a lot of excess that has been fostered by those combinations. And I think it's going to be anyone's guess as to what policy looks like going forward about what the push-pull is going to be.
That's a great lay of the land, and sets up nicely to tariffs. I don't want to talk about tariffs anymore after last week, because I can tie myself into a pretzel talking about, oh, tariffs are going up. Oh my God, no, they're canceled. Okay, they're just on holiday for a month or two. What does that do for your job? Do you see this regime shift happening regardless of where tariffs sit? Like, forget about in a week, if where tariffs sit in a year from now.
We don't even think about it, to be completely honest. I think that there is inevitably needs to be a reordering of the global financial system where the United States, it's easy to scapegoat the United States, but there's similar dynamics in a lot of other countries. But the US has the privilege, dare I say, exorbitant privilege of the reserve currency and the dollar. But you can't run 7% deficits indefinitely and just expect your populace and the world to fund that without repercussions at some point. So could this have gone on for another 5, 10, 15, 20 years? I have no idea. But at some point, the interest burden on that debt was going to have very negative consequences. And so maybe the tariffs, maybe the administration is pulling forward a reckoning of that, where typically what politicians do is just kick the can because that seems to be the easiest path forward. So We can't predict this, but what we do know and what we can control is trying to just assure that our portfolios have durable, resilient businesses. Because if anything, nothing is certain. But one thing that I think is an extremely high probability is that the path forward is going to be not non-linear. So you need businesses that can adapt and be resilient during these inevitable soft patches.
And what do those businesses look like? Take us through how you apply all this macro thinking into the portfolio at a high level, because I know we're going to get into it at a granular level.
So, at a high level, if you think about this regime change, it's very clear what you want to own in a historical context, and that is a real asset. So, just to define a real asset in very broad, generic terms, it's something that's tangible, it's something that's finite, it's something with inelastic demand. So, your paint by number indexed investing world thinks about real assets in three categories: natural resource companies, infrastructure companies, and real estate companies. All of these businesses might do good, great, fine somewhere on that spectrum. But the problem is that while there's a very compelling macro case to owning the underlying assets, the businesses themselves are capital intensive. It's very expensive to dig a mine, to build a bridge, to build an apartment building. And so that capital intensity creates a cyclicality and rate sensitivity that makes it a very difficult investment to benefit from over full cycles. We take that original thesis around why do you want to own real assets, hone in on the real assets that we think have the best fundamentals, but then critically overlay what we call a capital light business model. So these are business models where you have high operating margins, critically high operating leverage, meaning that the business can actually scale and improve margins as there's more volume and throughput, and then limited required reinvestment for CapEx, because I think that's going to be an increasing story going forward. And so we take the premise, which is very compelling: control for rates, control for cyclicality, and then control for that CapEx and margin exposure to what we think makes these businesses much more resilient and durable. That ultimately promotes compounding, which is something that's not necessarily something you think about with respect to real assets.
That's a really interesting perspective, screening out that cyclicality when it comes to some of that commodity exposure. And I can't wait to find out what names kind of meet that criteria. But before we get into it, I just want to paint one last scenario, because you said you don't think about tariffs at all, which is really hard to do in this market. And actually, maybe we should all benefit from that kind of thinking. But I want to paint a scenario where Trump goes sort of down this path, and there's a rebellion in the bond market. And bond investors often win all of their battles. And so the administration is forced to pull back from that. We've seen what even a whiff of pulling back can do for stocks. You know, the kind of rips that we've seen, last week alone was historical. So do you worry about that as a potential derailment to your view that, real world and maybe shying away from tech is not the path? Because if he does back off from tariffs, we just got a read of inflation in the US that saw an unexpected decline. Inflation was pulling back before all of these tariff announcements.
Yep. And we're never going to be tech investors. We know what we do well, and what we do well is owning these high quality, what would be more traditionally thought of as value businesses. We don't have any expertise in determining who has the best large language model, nor how that's going to be monetized, nor the sustainability of the moats around those businesses. But one thing that I will say is that I do think that it's very difficult to put the toothpaste back into the tube once it's been squeezed out. And so now I think you've started a chain of events that even if we get an announcement in the middle of this podcast, just kidding, we love everybody, no tariffs forever, free trade, there's going to be, no one knows if they're going to change their mind again. And so I think that there's already a reorientation of supply chains, of trade partners, and I think that was happening already. You heard about the BRICS countries trying to create a currency union. So this was already happening, and I think that it's going to create a lot of people to rethink that. And again, the a bet on the broader market, particularly tech that dominates it, is just so sensitive to those rates, margins, growth, and then ultimately the applications of these technologies, which you can get that pretty cheap just buying an index. We're trying to do something much more durable and value add in what we're applying our logic to.
So the market is betting, actually, we're going to get a bunch of rate cuts as a result of the tariff policy and the growth slowing. So growth will slow in the US because of tariffs. So we're going to get a bunch of rate cuts. And you could argue that the US dollar is reflecting that as well, because it's trading at around a 3-year low. The market sometimes can get ahead of itself when it comes to rate cuts and how many it's betting is going to happen. Do you think this is another one of those examples?
I do. I think that right now, the most likely scenario, which again, I have very low conviction in because there's just so many moving parts, let's call it low conviction, strongly held, is that we are orienting towards a stagflationary environment. And so what that means is there's going to be sticky pockets of inflation. And sure, they can jawbone down energy prices with what they've done. I mean, I'm sure there was some talk behind the scenes with OPEC, but what's going on right now with interest rates and the 10-year treasury, we'll see if that flows through into housing. But if you can combat housing where shelter dominates CPI, and then they don't necessarily focus on non-core, which has a lot of energy and food influence, you could theoretically manufacture a 2%-ish CPI. But then when you look at what we call localized measures of inflation, which are more consistent with everyday life, whether it's in business inputs or living inputs, that's going to be a lot more difficult because the companies that do have those products and services are going to push those costs. And so all of these variables would lead towards stagflation, which again would be maybe moderate, even robust nominal growth, but on a real basis, it's very low, if not negative. Um, so I think that that environment is going to be extremely challenging for the Fed, and we'll see. I mean, it seemed as though Jay Powell was holding his ground, and then there were some press releases that came out Friday afternoon, and then even over the weekend about the Fed being ready to act if needed. So I think that that definitely added a little bit of optimism that they would come around. But again, that stagflation risk, I think, is definitely on the table, and it's not just going to go away if we start to see calming in the tariff situation.
Do you see gold continuing to outperform and hit new records?
I do. Um, again, loose conviction, strongly held, but here is a very, very important data point. Pull up a chart of gold and overlay the US dollar index as well as the real US Treasury yield, 10-year yield. So that's the 10-year Treasury yield minus, you could use 1-year inflation swaps, or you could use tips, whatever you want. That correlation was incredibly high up until a couple years ago, where something broke in that, where gold broke out in spite of a very high US dollar index. DXY was 106, 107, and the real yield on the 10-year treasury was over 2. Those were consistent with gold being under 2,000 an ounce. Meanwhile, gold surging towards 3,000. So what does that tell you? That tells you that the paper players who dominate the day-to-day ping pong ball of gold prices were overwhelmed by physical markets. Now, there's a lot of anecdotes around what those physical markets are, but one that's very tangible is central banks. And I think central banks are saying kind of what we spoke about earlier is we were parking all of our excess reserves vis-a-vis a trade surplus with the US into treasuries. Great. 10 years, make 4%, a lot better than a lot of other developed market currencies. It's stable. But wait a second, they're running a 7% deficit. Interest is higher than defense. Is there going to be a shift in this ecosystem? And so I think it was sniffed out by gold, and gold sniffed out what was going on in the market. I don't think it necessarily sniffed out these trade wars, but it said this system is untenable, and the first wave of capital fleeing that traditional financial ecosystem ended up in gold. And I don't think people paid close enough attention to that. But because of that, and because of the fluidity of what's going on, I see more and more of a bid for gold. Whether it's central banks, you haven't even really seen retail participate, particularly in China and India. But again, if people are more and more skeptical of fiat currencies with incredible deficits run worldwide and growing debt to GDP ratios, gold's a beneficiary.
One thing that I think, when people were looking for explanations of the bull market, a lot of people, if it wasn't necessarily supported by monetary policy because rates were relatively elevated, there was so much fiscal spending, particularly in the US, at a time when other countries were pulling back. Now it seems like the opposite is true. The U.S., through Doge or whatever, initiatives, it is an era of fiscal restraint in the U.S., whereas, in places like Europe, because of geopolitics, all of a sudden you've got spending. And I'm curious whether you think that these are factors of U.S. underperformance and whether everything you've talked about is going to manifest mainly in the U.S., and that there's now greater opportunities outside of the U.S., that we're seeing the U.S. to the end to U.S. exceptionalism in stocks?
Yeah, it's a really good question, and it's hard to answer that directly, but I do think that the dominance of US markets and the dollar strength. So now seeing the dollar come down really sharply, and also seeing this outperformance of really moribund markets, particularly kind of some of the more industrialized nations in Europe. You're seeing some outperformance even in some Southeast Asian and emerging market economies, where I think it's long overdue a reconciliation. But you're going to have to see the earnings and the growth follow through to justify the multiples catching up. So it's one thing to just say, well, the US looks so expensive, but the US has also performed. But I do think that a lot of these events, as you mentioned, the fiscal orientation, where now Germany all of a sudden is saying we need to spend. And I think to the extent that these countries are able to finance that and run these fiscal packages, there's going to be a reconciliation and definitely more exciting opportunities outside of the United States going forward.
Okay, that's enough macro for me. Let's dip into the mailbag and talk about some of these stocks. Our first question is actually about a stock exchange, Intercontinental Exchange, ICE as it's known. Do you think the volatility will be beneficial for exchanges like the Intercontinental Exchange, and would you buy the stock here? This question coming from Doug in Mississauga, and certainly, we just got earnings from a bunch of these banks. We know the volatility has been great for stock jocks and the trading desk. It means, what does it mean for the exchanges? Because the other side of that is we might not get new issues, we might not get M&A. How do you think about that?
So great question. And so let's just back up, and the transactional side of the exchange, which is what drives the flywheel of other recurring revenue businesses around data, analytics, and services, is volume. Now, what drives volume on an exchange? Historically, it is nominal, very, very critical distinction, nominal economic growth, not necessarily real, velocity of money, and critically, volatility. So that volatility aspect, which it benefits both structural fundamental players and then speculators, because on the fundamental side, you need to all of a sudden hedge out your currency exposure, hedge out your rate exposure, with tariffs, hedge out your exposure to your input costs. That is a sharply upward sloping curve in terms of demand from hedgers. But then you also have speculators, and they thrive on volatility and bid-ask spreads. So now they're stepping into the market because they make all of their money during these types of multiple standard deviation events. So ultimately, it's this self-reinforcing cycle of trading begets trading and more volume. The beauty of the exchange and ICE in particular, well, not ICE in particular, but two things worth noting is that these businesses are largely just computers today. So for ICE to do another $1 trillion of SONIA futures on European rates, marginal cost of that transaction is effectively zero. But here's also the beauty of it is that while ICE owns the New York Stock Exchange, which was theoretically the in the driver's seat and should be dominating global trading today, that business was cash equity. You buy a share of GE. The problem is that's commoditized. You can buy and sell GE on any number of trading platforms, settle it, clear it, swap it. These derivatives, which is what drives all the profitability, is a function of their clearinghouse. So the clearing is what guarantees that your counterparty is going to pay you. That keeps that contract captive to ICE, but also gives them protection around the rate per contract. So now that creates almost a recurring revenue and this moat around the rate per contract. So the world that we envision comes to fruition. It's going to be an incredible environment for ICE as well as many of the other global exchanges. So yes, we own it and it remains a very high conviction idea for us.
So it pulled back. I mean, pretty much everything pulled back last week with the tariff tantrum. Is that kind of a baby out with the bathwater situation?
Yeah, it's funny you mentioned that. So when I started my career at Horizon about 20 years ago, I was actually working on the demutualization of exchanges, where a lot of them were private membership, seat-based ownership, and they were all merging and going public. And in 2008, 2009, they were sold off just like the AIGs and 30x levered banks of the world at the time because people thought they were financials. So to fast forward to today, they're still viewed as financials, even though you're talking 40% operating businesses that run with limited, if not any, net leverage. But here's another quirk of the markets and why I love the exchanges. So because about half of the revenue of ICE and other exchanges is transactional in nature, you have a April 2025 event, huge boom, tends to come down, but then stabilize at a higher rate. That creates this variability in earnings that the market doesn't like. Even though these things are growing high single digit, low double digits organically, the market's only willing to pay, 16, 17, 18 times this cash flow. Whereas something that's growing much less but perceived to be stable, so think like rating agencies and credit card processors, the multiples could be 50% higher for that perceived stability. So give me the higher growth rate with a little bit of variability at a 50% discount on the multiple all day.
So, because you like these real world assets, I'm curious how you think about a company like Brookfield. We got a question from David in Toronto. Do you think Brookfield is a stock that could help weather the current storm? You could look for the real world assets yourself, but that's certainly how Brookfield likes to invest, is buying up some of these infrastructure plays.
Yeah, I do. And I'll say that Bruce Flatt really needs to be acknowledged more for what he has built in terms of the distinct platforms at Brookfield. Now, let's just be careful to distinguish the two businesses. You have Brookfield Asset Management, which they recently separated as an independent, pure fee-based asset management business. I think that business is great. The value is probably greater in Brookfield Corp, which owns interest directly in the asset manager as well as their four permanent capital verticals. So you have permanent capital verticals in infrastructure, um, renewables, their traditional private business, private equity, as well as real estate. So part of the contention around Brookfield, which has been an issue for years, has always been around, okay, well, how sustainable are the non-fee recurring earnings, which means the carried interest, which are sensitive to exiting properties and assets at values and then earning that carried interest. But now there's a lot of skepticism around the actual value of their real estate. And so In this case, if you take Brookfield's internal marks, which historically have proven to be nothing but conservative across their complex, about 40 billion or about 25% of their gross net asset value is in these private real estate holdings. A lot of which of that is General Growth Properties, which is a tier one mall operator, as well as premier properties around the world. I mean, you could argue, but there's some assets in Lower Manhattan, Brookfield Place, Canary Wharf, some in Australia. But anyway, if you take management's marks for that, as well as market derived marks for all of the other assets, you could argue that Brookfield Corp's NAV is approximately double where it's traded today. Now, I did make some cautious comments earlier around traditional real assets, but I think a lot of Brookfield's clients, they're not necessarily looking for the historical 12, 14, 16, 18 plus percent net IRRs. They're simply looking to be put into assets that are tangible, that can deliver yields that grow commensurate with price. And I think that Brookfield's in a very unique position to grow that. And so while I think that their fee base is going to grow much more than the underlying return on those assets. And so that's why I love owning the general partner at Brookfield as opposed to being in the individual asset verticals themselves, which are really cap rate sensitive.
So that's Brookfield Asset Management, ticker BAM. You're not as interested in that as you are in Brookfield Corp, ticker BN. And it's trading, the US version is trading around $50 per share. And just to unpack what you said, you think the underlying value of the assets that it holds maybe suggests the company should be at $100 per share. So we got a big disconnect. You also have a sell-off in the stock since January. It's down about 30%. Is that all on the real estate concerns?
No, so it's actually related to alternative asset management platforms where if you were to look at a group of peers, so let's say Blackstone, KKR, you get a little bit less of a clean comp when you throw in Apollo, or Carlyle's a good one, but Apollo and Ares are much more credit sensitive. But all of these alternative manager platforms are down similar levels to Brookfield. And it revolves around the fact that there's this, what they call a DPI ratio. So these private equity companies have taken people's money, locked it up for 7, 10, 12 years, and they keep telling you that they're going up every year, but then they can't sell them for what they say that they're worth. And there was supposed to be a huge investment banking boom to start this year, which was going to be driven by PE sponsors selling their assets. But lo and behold, there's no buyers, certainly not at the prices where they're marked. And so a lot of these platforms have re-rated around, okay, can they continue to grow? But also, are they going to earn these carried interest fees, which are a really big delta in the overall profitability of these businesses, given what's going on with rates and what's going on with the economy? So that's more of a sector-wide hit related to alternative platforms as opposed to their real estate in particular.
Is Brookfield getting unfairly kind of sucked down with that trade in your view, or are you looking at the Blackstones of the world and Carlyle?
Yeah, I think that Brookfield is not nearly as exposed to traditional leveraged buyouts. So there were a lot of low quality companies that were levered up, and the market's just not at 2021 multiples. Like, no one's really interested in paying 14 times pre-tax cash flow for an HVAC servicing company. So even if they've grown it and done a great job operating it, if the multiple's gone down to 8 times, they're underwater, but they're still marking it at these old levels. Brookfield, I'm a lot more comfortable underwriting a lot of their assets that are related to infrastructure. I think renewables is finally kind of getting out of the penalty box. The infrastructure and has done great. And then their traditional business, which is more of your traditional LBOs, is much smaller, but they also don't get credit. They bought Oaktree a couple of years ago, and Oaktree has a world-class franchise in lending. And that's a really big growth engine, which is facilitating growth in what they call wealth solutions, which is really insurance. And insurance for private equity is basically duration matching these annuities, which is part of life insurance, which is another growth engine. So long-winded way of saying, yes, I think Brookfield has been unduly cast out with the other more cyclical LBO-driven alt platforms.
Big Howard Marks fan at Oaktree.
Yep.
Love me some Howard Marks.
Couldn't agree more.
Always good reading when he writes. Okay, good perspective on Brookfield. Let's talk some commodities right now. We've got a couple of questions. So you do see gold going higher. You told us that. This one coming from Marie in Richmond, BC. What are your expectations for gold this year? You've already told us higher. And do you have a favorite gold stock?
Sure. So, look, I'm structurally constructive on gold. I can't tell you what's going to happen 3 months or 3 years, but all of the tea leaves are saying more demand for gold, and there's just not a big supply response. And a lot of that is a function of what I spoke about earlier, just declining ore grades, lower exploration, lower exploration budgets, geopolitical issues. But how do you want to play gold? And the answer is, if you take a structural view like us, you want to own the gold royalty or streaming companies. You could look at the two big ones are Wheaton Precious and Franco, the kind of intermediate players, Royal Gold. The junior tier, without being hyper junior, would be a Cisco, Triple Flag, and Sandstorm. I'm constructive on all of those. But again, why do you want to own a royalty? They are basically growing on the back of somebody else's OPEX and CAPEX. So without going into the nuances of streams and royalties, effectively, you're getting exposure to production growth and pricing growth while being very insulated from the operating expenses and the capital expenditures of the mine, which is what's so detrimental to these businesses. So I would start there, but I'm going to give you another kind of further afield name for the gold ecosystem that I think is really interesting, which is called Sprott. Sprott is an asset management company. Eric Sprott is no longer involved in the business, but most of their assets under management are in passive precious metal, physically owned precious metal products. And I think, again, the world today, you want to own physical as opposed to rolling futures, and miners have just not been a great trade. Look at GDX. Compare the GDX ETF to gold prices since it was launched in 1994. You're up 4 times in the metal, and it's a very modest return in the miners themselves. But so if you think about Sprott, it's a 40% margin asset management business that basically just owns physical gold, silver. Now they have copper. They actually have a booming uranium business, but a fixed cost. So all that flows down to free cash flow. So to the extent that investors wake up and start reallocating to these products and gold continues to rise, you get all of that free margin expansion that all drops to the bottom line. So again, when you focus on the quality business models that are going to compound as opposed to trying to pick what's the next great mine or what's the next great management team, I think Sprott's a really interesting one to look at.
So obviously Canadians know all about Sprott and their different tentacles in the commodity sector. But when you look at the stock, it's just been a real yo-yo, bouncing around even over the long term. It has huge peaks and then prolonged valleys. Why is that? And like what gets it to be kind of a long term? What gets it to be sort of a long term conviction hold?
Yep. So there's a new CEO, a gentleman by the name of Whitney George, who's a value investing portfolio manager. He started his career and did incredibly well with Royce Associates. But he came in a number of years ago and really cleaned it up, where there used to be this investment banking and trading, and then they owned these subsidiaries. And what Whitney realized is that the market likes a clean cash flow story. And really just clean the business up where they have low cost call options on different types of businesses. So they do have some new active businesses. They do have some private financing, but the core of the business is a very scalable precious metal management company without all of that noise of these other businesses. And so I think that they haven't really gotten credit for that yet. But now that you've removed a lot of that noise around the cash flow and the balance sheet, I do think that the stage is really set for when this cycle gets moving for Sprott to re-rate accordingly.
That's interesting perspective. Let's finish up this segment with another question that might make the gold bugs crawl a little bit, and it's about Bitcoin. What are your expectations for Bitcoin now that Trump is a believer, and what do you think is the best way to get exposure? Do you like Bitcoin? You know, in your penchant for real world, maybe physical assets. What do you think about Bitcoin?
We are constructive, and I'll just give credit where credit's due. Our chairman and CIO, Murray Stahl, got most of our firm invested in Bitcoin over a decade ago. And he looked at it very fundamentally from the utility value of the Satoshi white paper. And he told, I'll never forget the day he went into our investment committee and told us all, invest no more than you would spend on a vacation, and you would be upset. It rained the whole time. Your kids got sick. It was a terrible trip, but you weren't just devastated that that money was essentially lit on fire, because you might be lighting money on fire. And so, quite literally, there's many people in our firm that are up well over 100 times, but he continues to be at the cutting edge of crypto, where he then said, look, we need to understand mining if we're going to understand crypto. And so we might be a little bit different from a lot of other maximalists that see the world as binary. It's either Bitcoin or gold. There's utility and there's different value and store of value and functional value of both. And so we do think that, personally, this is more my view, I thought that one of the biggest issues facing Bitcoin was the regulatory issue, but you've kind of taken that left tail off now that they've approved ETFs, they've approved a regulatory framework, and a lot of this was done even before the most recent election. And so now it's really a function of adoption and implementation into different systems. The problem is it's very difficult to think about how you would value it, but the mining break evens would suggest that either mining has to get much faster, which it's not really going to do, or cheaper, or Bitcoin has to go up. That being said, I would not invest in Bitcoin mining companies because they tend to be very poor businesses, very capital intensive, very high reinvestment capex. We've been looking for different types of Bitcoin oriented operating companies that we could get behind on a sustainable basis and really understand. There's some interesting ones with really good management teams. They're just really difficult to understand and properly underwrite. And so for this one, we think that the best way is to really just own the physical crypto yourself. Or we actually have a small ETF, the Blockchain Development Fund, which looks at companies that are in the ecosystem of crypto and blockchain and enablers of that. And you have a lot of exchanges and a lot of kind of ecosystem names, as opposed to having that really high beta related to the price of crypto itself.
So, how do you answer sort of the existential question about what is Bitcoin supposed to do for your portfolio? Is it a risk on trade? I mean, people called it digital gold. It's decoupled from gold. Now it trades more like sort of a levered Mag 7, but even that can be on and off depending on the year. Like, have you figured out what is the role it's supposed to play in your portfolio?
Yeah, I think a lot of people use it wrong because, to your point, I think you have a lot of um, tourists, for a lack of a better word, that see it going up and then pile in at all the wrong times. And especially people that go into these utterly insane levered vehicles, which just, I don't know how those things are even allowed if you look at the decay of these vehicles. But that adds this massive volatility component. But I think you have to look at it and say, you know, does it diversify from the traditional financial ecosystem, which I would argue, yes. And that's a lot of the same merits of gold. But there's transferability and things like that where you could argue there's advantages. And I'm not going to have that ideological debate. But to your point, I think that it's going to be very important that, to the extent that there is continued volatility, if Bitcoin is just a levered beta on Mag 7 in the market, there isn't that much utility from a portfolio construction standpoint. That doesn't necessarily mean that there's no utility of Bitcoin as an asset class itself, but I think it's still evolving and finding its place in global asset allocation mixes. But one of the most compelling arguments I've ever heard for gold and Bitcoin is that even the slightest movement in terms of global asset allocators shifting 50 basis points to either of these markets would just create there's just no way they can accommodate it. And so to the extent that there's a more widespread adoption of either amongst traditional asset allocation or even non-traditional RIAs, endowments, foundations, the incremental buying, I just don't see where the supply comes from. And that keeps me very structurally inclined for both.
All right, we're going to take a quick break. We've got a few more questions in the mailbag before we get into pro picks. For over 25 years, Raymond James has been helping Canadians achieve their financial goals. They are Canada's largest independent financial services firm with over 520 dedicated advisors, $88 billion in assets under management, and capital market services. With no proprietary product to push, their advisors are free to focus on the unique needs of their clients. Whether you're saving for your children's education, preparing for retirement, or safeguarding wealth for future generations, Raymond James is committed to guiding you every step of the way. Visit raymondjames.ca today to discover how you can live a life well planned. All right, our next question is about Enbridge. I noticed Enbridge share price wasn't really affected by current events and is trading close to a 52-week high. What do you think about it, and is it a good time to buy? This one coming from Adriana in Alberta.
Sure. So just full disclosure, I do not currently own Enbridge, but we are doing a lot of work on the MLP ecosystem because of the gas dynamics. So I will.
Just explain what that means for the master limited partnerships, and then what are the gas dynamics?
Sure. So master limited partnerships, there is a vestige of an old tax rate regime in the US where, because it's real property, you could distribute all of the cash flow of a pipeline carrying these commodities to shareholders tax free. And there was a huge boom in the US as we were building out infrastructure related to gas and to a lesser extent liquids, meaning oil, and then the liquid part of the gas barrel. And a lot these tax attributes and the yield made it a really booming industry. There were two problems with it. One, there was this misalignment of incentives between the general partner and the limited partner, where a lot of these pipelines had what are called IDRs, incentive distribution rights, where they would have made a hedge fund or a private equity manager blush at the amount of economics that they earned, which at the end of the day was at the detriment of the owners of the LP equities. But they were also priced as if were going to grow forever. And at some point, you have to question a company doing billions of dollars of revenue. Are you going to build pipelines to the moon? So because of that, they've been in the penalty box for about a decade, and rightfully so. They re-rated from 2-3% yields, in some cases now 8, 10, 12% yields. But here's why it's interesting again today is that the growth was constrained, and it was a function of lower 48 and to a lesser extent Canadian growth in hydrocarbon production. Now, U.S. has grown. It's been a very Permian-centric story, so it hasn't really been a boon to the MLPs, but gas is where it gets exciting. And why gas is exciting is there's structural growth around gas for the first time in a really long time, driven by three main factors. First and foremost and largest is LNG export. So personally, I believe gas is a transition fuel. It's significantly cleaner than coal burning power generation. The exact math depends on what type of power plant and what type of coal, but it's a step function improvement. We just don't have the infrastructure to get gas where it's abundant, namely the US, to a lesser extent Australia, also the Middle East, onto liquefied natural gas carriers, and then to where it's needed, namely Europe and Asia. That is changing, and you're seeing the US doubling LNG capacity over the next 18 months. You're also seeing investments in Canada for the first time, although last time I checked, they were slated to be converted to hydrogen at some point. Whether that happens or not remains to be seen, but that's a huge delta in domestic demand for gas in North America. Number two is grid demand. So U.S. Power, developed market power demand has been flattish for almost a decade because we've seen more efficiency. We've seen more efficient air conditioning. We've seen more efficient, computers, everything. But now the demand around data centers, AI, to a lesser extent, EV charging, by some estimates, you're going to have 20, 30% grid demand growth in developed markets. And that's going to have to come from gas because you can't deal with the intermittency of wind and solar. That can supplement base load, but it cannot be the dependent load. So that's another big driver.
So that's interesting because you don't like invest in the AI and the tech stocks themselves, but you're not saying this isn't a theme, this isn't a thesis. You just express it maybe in this area.
Exactly. The best way to do it is go upstream where you know the economic returns and you know where they have to go. The third is actually a function of that grid, which is coal to gas switching, which again is definitely aligned with going in the right direction in terms of carbon emissions. But because of that, for the first time in a long time, if you go through Enbridge's financials and their investor day, there's hundreds of billions of potential capex at very high return on invested capital to grow. And that's the first time that you've seen this identifiable growth in a long time. So we prefer capital light businesses where you don't have to spend these billions and billions of dollars. But I think that this is a unique situation with a different return profile. So at today's yields and the forward growth potential, I think that it's definitely something spending a lot more time on.
Do you have a high conviction idea? You said you're not buying Enbridge, but do you want to name drop anything here that fits?
Um, I might be getting ahead of myself. I don't know if we were going to talk about these pro names later, but one of the things that no one's talking about yet is water and the amount of water that these A, combined cycle gas plants need, but then B, data centers need for cooling. And so we've been looking at some infrastructure names around handling, treating, and supplying water dynamics around that same exact ecosystem.
Okay, we'll call that a tease because
Yeah.
you're right. That is one of your pro picks, and that's coming up in just a second. Let's squeeze in one more question. We've got one on Dream Unlimited. This one coming from Brett in Markham. A real estate play. There's a bunch of dreams out there. Which one do you like? Is this an area of the market that you're looking at for real estate exposure?
Sure. So not unlike Brookfield, you want to go to the parent, which is Dream Unlimited. Um, really have to give credit to Michael Cooper. He's built an incredible franchise. It used to be part of Dundee. I'm sure a lot of your listeners are familiar with the Goodman family of Dundee, but this was originally their real estate investment platform. I think Dream, that's what Dream stands for, Dundee Realty Asset Management. Anyway, Michael Cooper built it with the Goodmans and turned it into a juggernaut. And the thesis was always that they had these really attractive asset management contracts around their publicly listed REITs, which threw back all of this cash flow to Dream. Then they also had a lot of raw land. The raw land is mostly in Calgary, Saskatoon, Regina, Alberta. And in a real asset world, raw land, even if it's not in your core Toronto, Vancouver, Montreal, is one of the preeminent assets. You have a very low to negative carrying cost, and you have all the upside on the optionality of land. So we love raw land. They also have some stabilized assets in the form of operating real estate, namely multifamily and some commercial in the distillery district of Toronto. So again, if you combine all of the different cash flow platforms and NAV at Dream, again, you've got development, which is Western Canadian land lots, stabilized cash flow from mostly the distillery and multifamily, and then you've got about that 25 odd billion or 22 billion of third party REITs, mostly Dundee Industrial REIT. Um, the book value of Dundee as of year end, I don't know if they, yes, the last time they reported was year end, was almost 100% higher than where the stock is trading today. So it's small, it's illiquid. people can give me 100 reasons why it's not that value, that why it's trading where it is. But typically, when you buy something at 50% of what I would say is a conservative liquidation value, a lot of things can go right. And I do have a lot of faith in Michael Cooper and his team to figure something out for you.
Does there need to be, that's what my question, does there need to be a transaction in this environment? Are we going to see one? Because you can say that, the fair value of everything they own is so much higher, but it's just been a one-way ticket lower for the last couple of years. But even in the last, call it 6 months, the stock's been cut in half. It's down about 50%. What are those, special things that Cooper and Co. could potentially do? Like, I assume it has to be a transaction. But are we going to see that in this environment?
Probably not. I don't think they're going to force it. I mean, they own a tremendous amount of the company themselves through Sweet Dream, which is their holding company, and they're going to do what maximizes the value of Dream Unlimited for themselves and you as a shareholder. But again, this is the chicken or the egg with so many of these incredible small cap companies. If you don't have the requisite trading volume, it's really, really difficult to get a market multiple. And we see it on the TSX Venture Exchange in Canada. We see it on the AIM Exchange in London, where this lack of liquidity is such a difficult variable to work around. But I would say, under the right terms, Dream would certainly be attractive to somebody as an acquisition, but I think it would have to be structured in a way that either they paid a full market value or they allowed shareholder to maintain upside. And that's why I don't think it's probably going to happen tomorrow.
All right, let's get into your pro picks now. Pro Picks is brought to you by ATB Financial. With $62 billion in assets, ATB Financial is powering possibilities for more than 820,000 financial services clients in Alberta and beyond. ATB's capital markets arm is a full-service investment dealer that offers investment and corporate banking, sales and trading, institutional research, and risk management. Visit atb.com/inthemoney for more information. Your first pro pick is Aris Water Solutions. This one you hinted at. If you want to play on growing energy consumption, is it that people should think about all the water that is required to be part of that story?
Yeah, and so Aris at its core is a water handling company for Permian oil and gas producers. And so this might be surprising to your listeners, but in West Texas, particularly, you have the Permian Basin. And so the Midland Basin was the eastern portion that was developed first. The Delaware is deeper and more complex on the west side, and it runs up into New Mexico, which is where a lot of Aris's assets are. But for every barrel of oil equivalent, which has parts oil, parts natural gas, and then parts liquid petroleum gas, so things like ethane and butane and propane. For every barrel of oil equivalent, there might be 4 to 5 barrels of what's called produced water that comes out of that well. If you think about the hundreds and billions of dollars of infrastructure in the Permian Basin dedicated to handling oil and gas, 5 times that is going to be required for handling this water. And so with Aris's network, basically what they're going to do is right now they're making most of their revenue by handling this produced water and then recycling it into these disposal wells. As the industry matures, they're recycling more and more of this, which is creating higher and higher margins because you're basically earning more margin on the same barrel of water that you're taking away and getting paid to take that away from the well site. This is also looking at different types of desalination technologies where you could actually use it for things outside of the oil and gas industry, one of which would theoretically be this liquid cooling and then service in these power generation turbines. There's also pilot strategies, technologies in iodine extraction and other types of trace metals. And so there's a lot of different ways that Aris can grow throughput, pricing, margin, and other types of new emergent revenue streams on the existing asset base, which, as it stands today, is earning about a 20% return on invested capital, even though it's running at about 60% capacity.
How much upside do you see? It's trading at 24 bucks.
So it's trading about 10 times operating cash flow today. And this is a company that's grown revenue at a 30% CAGR since IPO a couple of years ago. So even I'd say modest execution on growing top line and margin, this business should trade at 15 times. So if they could grow their cash flow 20, 25, 30% over the next 18 to 24 months, and then they get rewarded as they should with a 15 multiple, you're not doing mental acrobatics to see a doubling here.
Thank you for doing that for us. Sometimes our guests just leave that for us to do the math. So a possible double from here. You talked about how much you like exchanges, and that extends to TMX Group in Canada as well, which of course is the owner operator of the Toronto Stock Exchange. But it's so much more than that, right? It really has evolved to being like that data company, and does have big derivatives exposure as well through some of
Yep.
its recent acquisitions.
Yeah, so as I mentioned earlier, I think they're dominant in Canada. Where between the TSX and the TXX Venture, they have over 65 market share in Canada. But that's for listings and capital formation and equity trading, which is still a good business. I would say that the really interesting business, which is, let me check my notes here, about 30% of revenue is this derivatives trading and clearing. And so they have the Montreal Exchange. They also have a really interesting business called Trayport in Datalink, which is European energy. So you'd never think that the TMX was controlling a lot of wholesale power trading when European power prices were blowing out a few years ago because of gas prices. But when you think about the entire ecosystem of the TMX, you have the transactional revenue around these derivatives that were structurally positive on with margin and with clearing. You have the capital formation of TMX and TSX Venture, which on a low base, I think has room to improve. And then you have the data and analytics with businesses like Vetify, where they bought Vetify, I think, to really try to grow the ETF business. And so the ETF business is enormous in the US. Canada's catching up, but you'd be shocked at how early stage in Europe and other parts of the world ETFs are just an afterthought. And so I think there's a lot of green field ahead for the Vetify business to continue to grow ETFs worldwide, but also through the TMX ecosystem. And so one thing about exchanges is because they're such great business models, they aren't the cheapest. TMX trades around 20 times operating cash flow, but we think in the right market conditions, they can grow that sustainably high single digit, low double digit. Very good at bolting on acquisitions. There's definitely some room for margin on top of that. And so we think of this as a sleep well at night compounder over the years where you're not going to get rich quick, but you'll get rich slowly.
That was going to be my question. You took the words out of my mouth. Is valuation. If I hear any bear thesis around TMX, it's the valuation. So you kind of answered that you just kind of put up with it. Your last one is more in the commodity space. We haven't talked too much about energy. We've talked about you being bullish on gold. So your third pick is Prairie Sky. Obviously, with oil prices plunging, now hugging around the $60 per barrel mark, this is an interesting play. Do you have conviction that oil prices are going higher? And we know you prefer royalty plays in general. So is that why you're positioned in Prairie Sky?
Exactly. I mean, first and foremost, you just can't replicate 18 million acres of royalties in the Western Canadian Sedimentary Basin. And as you mentioned, with oil price volatility, it's very painful to be in a producer that needs 65, 70, $80 to make an economic return. I mean, people throw out all these silly numbers about break evens that are using kind of fairy tale math, but there's not many companies that are earning robust margins and can earn their cost of capital in the 60s, which is why we own it through Prairie Sky as a royalty, where they earn 60, 70% margins as just kind of clipping royalties off the top. They, as of right now, are exposed to, let me see here. nearly 30% of capital expenditures in the Canadian energy industry that you're basically getting a free ride on through a royalty vehicle. But so back to your point about energy and energy prices, I think that if you're willing to look through the noise, unfortunately for the world, hydrocarbon demand, mostly gas, but still certainly oil, is upwardly sloping to the right. You've seen a dearth of investments worldwide. We'll see as OPEC gets their barrels back onto the market. But the world has been investing and positioning for a world where we hit peak oil now. I mean, there were people in 2020 that said 2019 was peak oil consumption. The decline rate of conventional reserves worldwide is 6, 7%. Shale is multiples of that. And the lack of investment over the past decade around this incorrect thesis of declining demand and obsolescence around hydrocarbons, it's going to catch up with us. And I think once we clear the extra OPEC barrels, we'll see what happens with with whether or not there's a recession. Nobody knows what's going to happen with China, but I think structurally, unless there's a very severe left tail event with demand, we're not going to have the hydrocarbons to balance the market. And it could be as early as 18, 24 months. And maybe that'll be what catalyzes a more rapid transition to different types of fuel sources. But we're of the belief that we're going to continue to grow probably until about 2030 in terms of global oil demand. But then there's going to be a very long plateau that the world is not properly prepared for. And that's mostly around non OECD countries where we in the West are asking them, you do as I say, not as I do, where we're saying decrease your energy consumption intensity, whereas we're many multiples of India, China, Southeast Asia. I mean, forget Africa, sub-Saharan Africa. And so the industrialization of that part of the world is going to keep that consumption elevated for many, many decades. And so I think we're very positively inclined to that right tail beyond kind of 1 to 2 years.
Okay, so, that's looking beyond a potential slowdown in the US. The stock's pulled back about 27% from its recent peak. What kind of upside? Does it go back above 30, or is it like, do you see new highs?
I think there's going to be a lot of volatility around. You can never escape, even though you're insulated on a margin and a free cash flow conversion standpoint, you can never escape the sensitivity that you ultimately do have around the oil price sensitivity. I think that the market is very delicate at this point. 60 does not work for OPEC because even if their wells technically break even in the 20s, if you add in the fact that they have to fund their entire government and social programs, Saudis probably need 90 to 100 to not be dipping into reserves. Some other countries are lower, some are higher, but you're also not going to see U.S. shale as much as we want to say drill, baby, drill. And I have a very high opinion of Chris Wright, the Secretary of Energy in the U.S., who formerly ran a fracking company. He should know darn well nobody's going to be adding capex and adding rigs at 60. And so the situation could correct itself before you know it. So I'm of the belief that there's definitely skew to the upside. But I do think that as people look to play an eventual recovery and they want to own that through a quality modality with a very robust dividend and a lot of safety, Prairie Sky is going to attract a lot of eyes.
All right. Thank you so much, James, for your insights and for all of your ideas. We appreciate it so much.
Yeah, my pleasure. Really happy to do this. Thanks for having me again.
That's James Davolos joining us of Horizon Kinetics. Coming up on our next episode, we've got Rob Moffat on the show. He's a manager with Middlefield, and he deals exclusively in healthcare stocks. And you might think in market turmoil, healthcare is where people can find cover, but not in this sell-off. Healthcare stocks are trading at around a one-year low, whether it's tariff uncertainty, big changes that are being brought in by Robert F. Kennedy Jr., or just that run-of-the-mill business of coming out with new drugs. There seems to be problems absolutely everywhere. Where are the opportunities? We'll find out with Rob Moffat. You can get your questions in now. Anything about healthcare, pharma, biotech, send those questions in. Questions at inthemoneypod.com. You can hit us up anywhere on social media at inthemoneypod, and we'll see you on the next episode.